Elis Service Group has published the first quarter revenue results, a press release, and I want to comment this release. I did some small analysis and I have some questions also that I would ask on May 19th if I would be there. And then also some stuff that they did not talk about. So this is also interesting. So stay tuned and we'll see us in this video. Hi, my name is Christian Wurzelball. I support the textile service industry with management training, know-how in textile service 4.0 and practical hints that I can implement right away. Now again to Elis for popular demand. They have released the first quarter sales. And I tried to make an analysis about this. And the main issues now for this video are there is a strong rebound after COVID-19, which is good. Then there the 15% growth for 2022 seem to be very realistic also from my side. So who asks me? But I personally think that they are realistic. And then the question is, what is organic growth? And then some objectives need more background information. At least I do not understand them. And I question whether they are realistic. So we can talk about this. And then there is the inflation issue, which is a main challenge that I think is not as much addressed by Elis as it is. And then there's also the question, what does Elis not publish? So if you want, you can also, there will be timestamps in this video and you can go to the chapter of your liking and or you can watch the whole stream. So first of all, what is organic revenue? It should be very obvious what organic revenue is. It's on the one hand new customers, of course. When you get new customer, then this is organic. And then of course you have to deduct the customer churn rate. So how many customers to leave the company, especially in textile service, you have long-term contracts. So which contracts are not renewed? Where does the customer look for somebody else or closes his business or whatever? So what's the churn rate? And then Elis. Elis has some own definition of organic growth, and they include a small M&A in organic growth. So everything that is below 3 million international and 5 million in France is called organic revenue. So if they buy in France a company with 4.5 million in sales, then this is actually organic revenue for Elis. From my point of view, it's not. That's my personal taste. And there are quite a few transactions, so it's not a minor issue. So there have been 17 transactions with 30 million euro in revenue. That's at least what I have counted. And this makes up 1% of revenue. So they made 1% of revenue with small M&A that they report as organic growth, which is, from my personal point of view, from my understanding, actually external growth. Then of course, you have the issue of inflation. So price increases are part of organic growth, but it's you do not gain market share. You just keep your margin. So we have cost increases in this industry of 10%, 12%, in some cases even more. So I would say Elis on average has probably between 6 and 10% price cost increases. So the price increase of 6 to 10% is actually inflation and not market share. And then you have the rebound from COVID-19, which Elis actually also publishes as not really as they excluded in some cases with external growth, organic growth, but then they included as well. So from my personal point of view, new customers less the churn rate, that's actually organic growth. That's from my personal taste, because this shows that you have success in the market, and you gain market share with organic growth. This here is, from my point of view, from my personal taste, not organic growth, but in Elis it is. And this is actually a sickness, the inflation. And then you have the rebound from COVID, which is also not organic growth. So that's just an introduction to what I want to discuss now. That's the press release. It has a very strong title. Strong revenue growth in Q1, 26.5% and 24.2% on an organic basis. So yeah, as we discussed already, this is of course not the case that everything is real organic growth. And then why? Because there is a rebound in hospitality, which is most of this 24%, of course. Before they had 25% reduction in revenue, and now they have an increase. So most of it is rebound. And then they got also new customers, obviously, in all end markets, especially in workwear and in hygiene. And of course, they have the impact of inflation. And then they have growth in all geographies, in all 6 regions, which is good. Then the outlook for this year is confirmed. So I personally can also confirm, and I will show it later on, that the 50% revenue growth this year is actually very realistic. And then the energy price inflation is very strong. So they say that the EBITDA margin is just 33.5%. I personally, from my personal opinion, is that this is even a risk. So there could be a risk that it's even less than 33.5%, because the inflation is not just the energy price, it's also wages, it's everything, it's cotton, it's transportation, it's everywhere, it's chemicals. So right now, this year, I've made a video about this. If you're a laundry with flat linen, you can have up to 18% inflation. So I would guess that Elis itself has something like 8% inflation. But I do not know the right number, but the inflation of Elis is at least probably 8%, maybe even 10%. Then you have the EBIT of 500 million. We can talk about the definitions later on. From my point of view, it's not EBIT, so it's actually EBITDA, because it's earning before interest, tax, and amortization of goodwill. That's 500 million. So if it's without the amortization of goodwill, then we are talking probably something like 320 million. Which is the actual EBIT margin. The headline net income, increases by 40%. And then the free cash flow, I think we should also talk about this definition here, because the free cash flow does not include M&A, which is also okay for a normal company. So in a normal company, you would not include the M&A in the free cash flow, and you would pay the acquisition of new companies out of the free cash flow, or finance it out of the free cash flow. Yes, but with Elis, they are actually growing with M&A. There is I can show you later on, almost no organic growth, at least what I can see. So M&A is actually their business model. And if you are in M&A such a big time, then actually it starts not to be free cash flow anymore. That's my personal opinion. We can talk about this later on. And then this is also a very challenging goal of 2.6% financial leverage ratio. I'm not so sure whether this will turn out, or I do not have all the information, but I will discuss this also. So stick around in this video. I will give you all the backup information. Yeah, then the CEO makes some interesting comments. So furthermore, the client retention rate is improved in Q1, underscoring Elis' reliability and quality of service. Yes, this might be the case. So I do not want to question that if the reliability and quality has increased, of course, this will also improve the retention rate. But we have right now a seller's market. So right now, the laundries all over the place in the whole industry have too less employees. So all over the place, the industry had to reduce the payroll during the COVID-19 crisis. So many laundries reduced their staff by 50% or something, some even more. And everybody in the industry, especially in hospitality, has right now the challenge to get new workers, to get them back because they are gone. They are either in their home country, they are in different industries, they are fed up of the laundry industry. So these people have not come back. But the volume has come back. And so the industry is right now in a position that you are not able to service new customers. So when you are a customer, you are a hotel, or you are even if you are a hospital, then you might not get even a quotation from a different laundry because there's just no capacity. So we are right now in a seller's market, and this will change, of course. This is not very common, and I would expect that at the end of 22 or in 23 we will change again into a buyer's market. So the hospitals and the hotels, they will be able to choose. And so what I want to remark here is that the client retention rate here, if this has improved, is not necessarily the cause is not necessarily the reliability of Elis and quality. It might be, yeah. I do not want to question it, that there has been an improvement, but most probably the main impact of the client retention rate is actually the seller's market. So that's my personal comment on the comment. And now it goes on. The revenue. So as I mentioned before, the external growth actually includes also does not include the small M&A. So if the small M&A would have been included, sorry for this English, then it would have been 2% probably, and the organic growth would have been 23 something, 0.2% probably, something like this. So that's the point here, because there have been 17 acquisitions that have not been included in the external growth in their reporting. Then you have, of course, foreign exchange, and where you have Latin America. The euro right now is in free fall. When the Brazilian real is stronger than the euro, then you have to question the ECB. That's a different thing. That's actually one of the main causes of inflation. And that could also be the cost when that inflation could persist. Yeah, let's turn to my analysis of the revenue. First, let's have a look at the seasonality of Elis. So the first quarter in 2018 and 2019, these 2 years should have been quite normal years. So it was pre-pandemic. It was not it was normal M&A. So there was no Berentzen acquisition there. It was just a normal year. So in this year, 2018, the first quarter made 23.8% of the full year, and in 2019 it was basically the same amount. The first quarter is probably one of the weakest quarters at Elis. This could be because of seasonality, but I made it in parentheses. The main reason is most probably the M&A process, because when you consolidate then the revenue of your targets during the year, then of course the first quarter is the lowest revenue. Yeah, and you see, for instance, here in Latin America, they have the summer season and winter. So right now it's summer or it's autumn. This is also a high season there. And when you then calculate this, then you can make a forecast. So I multiplied the first quarter by the by this number that I showed you before. Then the forecast is 2.5 billion euros for Elis in total, and this would make up a growth of 230 million euros from 2019, which is nice. So Elis is better than before the pandemic, which is a nice information. And part of this of this number is of course also the M&A process. And when you add the acquisitions, which is of course not scientific because I do not have all the internal information here. I just added up the M&A process since 2019 and before 22. So in the year 2020 and 21, in both years together, it was 120 million euros. Yeah, and so basically more than half of these 7% growth is actually M&A. So the organic growth is something like 3.2% or something like this. And this, of course, includes also inflation. Yeah, then you see the different regions. There has been more growth in Central Europe, and actually Latin America is down. So it's down, and even when you then deduct the M&A, then it's even more. So then we are talking about 10%, which is foreign exchange, of course. Yeah. So that was the revenue analysis from this perspective, and then you can make this also in the chart. So this chart, I have explained this chart more in another video, and you can show it. I invite you to have a look at this video. So I have continued this old chart that I published before, and it starts in 2012 with the original revenue of Elis of 1.2 billion euros. And so this is the beginning of the story. And and when you just add the M&A and subtract what they disposed, so there was one disposal, but otherwise they bought every year, I don't know, 10 to 30 different companies, and you just take the original revenue and just add and subtract the M&A process, then you arrive at this orange graph here. So that's just M&A. That's no inflation, no new customers, no lost customers, nothing, just M&A. And what you see is that until 2018, there is almost a perfect match with the actual revenue of Elis. So until 2018, you could say that the total growth of Elis was basically M&A, which of course was not the case. So they got obviously new customers, and they lost also some customers. So at the end of the day, growth was M&A. And then, of course, you need also to include the inflation. And in the gray graph, I included inflation of 1% until 2021, which is actually low. It should have been probably 2%, because when you say that 8% of revenue is Latin America, and Latin America has an inflation of something like 7%. Of course, you lose it also with FX then. But so 1% is until here, my assumption, and then for the current year, it's 8%. Why 8%? You can also look up another video, but this industry has been impacted by inflation big time. On the one hand, energy prices, on the other hand, chemicals, labor, big time. Then cotton price is, I don't know, 50% up. So inflation is high, and 8% is maybe even conservative. So the message is, if you adjust the price of the M&A process just with inflation, then you are at a number of 3.7 billion euros. So that's basically the starting point for organic growth. And so normally when you would have organic growth, then you would grow with M&A, yes, but you would also grow with new clients. So you would get always each year new clients and lose less than you require, which is called organic growth. And this is normally the graph of organic growth. So this would be organic growth. Then, of course, even with organic growth, you would have had a COVID crisis, and then you have a rebound, and then you are something like here. Sorry. My pen is not working properly. So this here is actually organic growth. So when you are above the revenue that you adjust for inflation and for M&A, then this would have been organic growth. So they are actually still below their trend line. So if you are there on the 19th of May at the shareholders meeting, please ask Elis about this chart. Maybe I have something wrong here. I do not say that I have all the wisdom and that I could not make a mistake in Excel. But if this is correct, and then I do not see any organic growth at Elis. On the contrary, I think they are below their current growth rate. So they burn more customers than they get new ones. Yeah. So that's the one thing with organic growth. And then back to the press release. The comments regarding the regions are not so interesting. they have increased confidence in the outlook of the forecast for 2022, and this is interesting. They say that there is a strong price inflation, of course, a strong energy price inflation, which is just one part of the story, of course, and and they say if the inflation, if the energy price in Europe is beyond 100 euros per megawatt hour, they would charge for every 30 euros per megawatt hour 1% more to their clients. I think this is not a good idea because it does not account for the inflation in labor, in cotton, in whatever. So just to publish in a press release that you only increase prices when you are having higher than expected energy cost, this is not a good idea, because I cannot. If I am a customer and I see this press release and the sales rep or customer service rep, the regional manager comes to me and says, I want to increase prices, then I would say, okay, has the energy price increased beyond 300 euros per megawatt hour? No. So please, we'll see us next year. So I do not think that this is a good idea to publish this in a press release. And I think that the inflation, as I mentioned before, is rather something like 8 to 10%. That's my calculation. Then EBIT, we already talked about it. From my point of view, it's rather EBITDA. And then the financial leverage. Yeah, this leads me to this chart regarding the financial leverage. So let's talk about the financial leverage. Is 2.6 realistic? I don't know. Maybe I'm missing something. Please post me a comment if I'm wrong here, if I misinterpret something. I'm not sure. I don't understand this number. So what I understand and what I can also follow is these 3.5 billion euros in revenue. I would even say that there's a chance that it's 3.6, because I think from my personal point of view that 3.5 doesn't include all the inflation adjustments. Yeah. Then we take the EBITDA of 33.5%. Personally, I think that there is a slight risk even here that it's lower because of inflation. And this makes then, say, 1,174,000,000 euros in EBITDA. And when you multiply this then by 2.6, should be a point in English, then you arrive at 3,053,000,000 euros in debt, net debt. That's the target. So that's what he wants to reach. And the current net debt is 3,145,000,000. So if I'm seeing this correctly, Elis needs to reduce the debt by 92. So there needs to be a reduction of 92 million in debt. Okay. The question is then, is this realistic to reduce the debt of for 92 million euros? And this leads me to the other slide. The Mexico transaction, if it turns out to be, then it's 160 million euros. And I'm sure that there are another 40 million at least in other M&A transactions. They have already published some, and I would say at least 40 million in addition. So we end up here with 200 million in M&A. So when you have 200 million in free cash flow and you pay now again dividend of 78 and you have 200 million in M&A, then you increase your debt actually at 78 million. So you should have had in the previous slide a decrease of 92 million in debt, and you increase the debt in this case of 78 million, and this makes actually 170 million in that you have to finance some for instance with equity. So if you issue equity of 170 million, then then you're fine. Then you reach the 2.6 leverage ratio. Otherwise, I do not know how you can reach it. I don't know. Is there another way? Am I wrong? So please clarify this for me, and also maybe ask the CEO or the CFO on how what is wrong here. So that's just their numbers. So everything is from Elis. It's the revenue. It's the EBITDA, it's the current net debt of the financial report, it's the target net debt, obviously, and it's also the transaction that they are doing, and the dividend they want to pay, and the free cash flow that they are promising. So please explain me these numbers. Unless they issue shares or convert debt to equity, then it doesn't add up from my point of view. So now back to the press release. The medium outlook is, that's also interesting. They expect that all the geographies, all the different industries will recover, basically, and that they will have organic growth in the market healthcare industry and trade and service, which makes up 75% of Elis. They expect 5% organic growth. Question: does this? Sorry that I'm nasty here. What about inflation? Is this inflation adjusted? Is this real growth, or is this just adjustment for inflation? And if it's adjustment for inflation, then it's maybe even too low. And what is also interesting is that they want to have organic growth of 3.5% in future, and yeah, it's good, but they have not done it in the past. So please show it to me, or maybe I do not understand something. And this is also interesting, that the margin decreases in 2022 because of inflation, and it will recover in 2023. And actually, I do not see this. So inflation is always a burden to the margin, always. So you have during the year increases in input costs, like textiles, like energy. So if you then hedge energy, then this is stable. But but you have many input costs, or the gasoline that you have for your cars, the wages that you have to pay to increase for new employees during the year in order to get them on board. Or employees that do not want to continue working because of inflation and they demand a higher salary during the year. It's not easy to go to your customer and say, I need to increase my price by 3% just because a few truck drivers go on strike and want more salary. But this is the case with inflation. So you have wage inflation even during the year. You have input costs that are rising during the year, and you do not get this whole refund from your customer. So inflation is always a handicap for the margin, and it will not change in 2023 unless we have a recession and the inflation goes down to zero. Then we have a different problem. So I do not buy this sentence, sorry. Yeah, and then they are talking about other stuff like circular economy and non-financial rating and climate and so on. Yeah, and then they end up with financial definitions. And personally, I have some, so organic growth, we talked about this. I have, and here you see the issue that I'm talking about. So this organic growth is the group's growth, excluding the impacts of changes in the group scope of consolidation of major acquisitions, and these acquisitions are defined in this universal registration documents, and we are talking here a minor acquisition is below 3 million outside of France and below 5 million inside of France. So that's and then of course also excluding the impact of exchange rate. So organic growth includes actually the inflation. It includes the small M&A. It includes also COVID. So that's organic growth. And then of course it includes new customers and the churn rates and stuff. Then EBITDA, they exclude some costs out of EBITDA that should be included, but I think that EBITDA in general is not a good number because it's you lack the textile purchases, which is a big part of the business model. So EBITDA is actually not the best number, and then EBIT is actually from this definition in EBITA, because it also excludes the amortization of intangible assets. And when Elis buys so much goodwill on the balance sheet each and every year due to their acquisitions, then the intangible assets are actually that you need to depreciate your intangible assets, because when you have a customer list, you acquire a customer list, and this customer list is after 10 or 15 years of no value anymore. And normally you would depreciate it. So this is, I think, a stretch not to include the amortization of goodwill. And then the free cash flow, the same thing. This is minus working capital, linen purchases, manufacturing expenditures, net proceeds, tax paid, and so on. Financial interest, yes. Lease payments, yes, but it excludes the M&A. And of course, if you buy the market leader in Mexico, I understand that this is not part of the free cash flow. But if you buy a small company in order to avoid that you need to buy linen, or that you buy pay your salesman for sales effort, and you buy a company as a bolt-on acquisition, then a bolt-on acquisition is, from my point of view, part of the business model of Elis, and it should be included in the free cash flow. So what about bolt-on acquisitions here? So from my point of view, this is not the best metric here. Yeah, and the financial leverage ratio is not, that's okay from my point of view. So that's the comment of the press release, and the question is then what was not included in the press release. And this was basically, on the one hand, there was no statement about refinancing. They need to refinance about 1 billion euros, and if they want to refinance their M&A, then it's even 1.1 or 1.2 billion euros this year. And then the question is when and what conditions. And I see personally, there a real risk, because when you look at the current yield of Elis bonds, then we are at 4.1%. And personally, I would not be surprised if they need to pay something like 6 to 10% coupon for refinancing. So the question is, why should an investor have a negative real yield with Elis? So and in this case, with 1 billion, we're talking with 6%. Right now, they are financing at 1.6%. So in order to have an easier calculation, if they need to pay a coupon of 7.6%, then it makes an additional cost of 60 million euros, which is not included in the free cash flow. So you reduce the free cash flow from 200 million to 140 million in this case, which is something. So I think there is a risk here, and then of course there is no statement about Mexico. I don't know. Maybe they are. They will not go on with this transaction. The funny thing is that the Mexican peso is now stronger than the euro and has appreciated 12% since January. So they negotiated the purchasing price with the Mexican company, and now they have to buy another 12% in order to buy Mexican currency. I mean, it's ridiculous. So maybe this is the reason why they are not talking about it. I don't know. So if you like this video, then give it a thumbs up. And if you want to see more videos, then subscribe to this channel. And I'm sorry if this was a long video, but I think it's interesting. We'll see us in the next one. Bye-bye.